welcome to TheoTrade. This is Don Kaufman. It's January 11th, 2019, and you are watching the TheoTrade Weekend Update. Let's get right to it. In Fed we trust. What does that even mean? It effectively means the Fed putting a backstop underneath this marketplace. The Fed speak this week was extraordinarily dovish, gave the S&Ps another 60 points, almost to the button, back to the upside. In fact, in a couple of moments when we get to take a look at the markets, specifically a couple of charts, we're going to talk quite in depth about debt markets right now. Are debt markets effectively saying, well, the same thing as the Fed? Again, the Fed puts their effective put back in place. For those of you that don't necessarily speak option geek, as I said a moment ago, the Fed is effectively, with their dovish speak, is backstopping the entire market. And again, this week it was a Fed fest. I mean, we had everybody on deck throughout the course of the week giving more dovish rhetoric, more dovish comments. But you just have to recognize, okay, the entire marketplace, put earnings aside, forget fundamentals, there's no technicals. All we basically have, it's just you and the Fed. That's why I kicked this off with, in Fed we trust. Now, I, again, will get into more depth about this when we take a look at the charts. Enough on that point. Next, let's go to the SPX. The SPX, all right, for those of you that tune in on a week-to-week basis, you look at the expected moves. The expected move for this previous week of trade was right at 60 bucks. What did the SPX move? Just a tiny bit north of that $60 expected move. Effectively, what we're saying, the market was incredibly efficient this week. It just hit the expected move pretty much spot on. Now, next week, okay, the expected move has actually contracted even more considerably. Again, in just a few moments, I'm going to show you this, but there's a much larger, okay, I would guess, issue in play right now when it involves the broader S&P, especially for those of you that if you do trade options. And, well, what's really at issue? Well, what's at issue has to do with realized volatility. Again, for those of you that don't necessarily speak geek, I've been talking about this kind of incessantly the last 2 weeks. Realized volatility, what is it? It's actual price movement inside the marketplace. Realized volatility has been running in and around about 30%. What does that really mean? Again, 30%, you know, it's moving up and down at a rate of about 30%, okay? And that's averaged, again, just the last couple of weeks, which, again, I'll show you here in a moment in the charts. The issue is implied volatility. What's implied volatility? That's the volatility that it's the option market, okay? And the option market is always handicapping out to the future. Implied volatility, that's been running around 20%. So think about what you have over here, huge kind of catch-22. Implied volatility is supposed to be really good, okay? And again, handicapping how much is the market supposed to move in X amount of time. Except, okay, it says 20%. The market's really moving at 30%. Something, people, has got to give. And we're also going to look at here momentarily a little bit about volatility skew. The volatility skew has flattened back out. There's also going to be some pretty wicked deviations of realized volatility versus implied volatility in none other than the VIX. There's some pretty incredible opportunities inside of the VIX right now. And the last thing we're going to get to, of course, on this video, and I'm going to show you this in a couple of moments, is, well, earnings. We're going to kick off earnings season. Are you excited? As I just said a moment ago, does it really matter? Because it's all about the Fed. But the market, I think this last kind of couple of days had this almost like eerie pause where all right, let's wait for earnings. And of course, we're going to kick off earnings early next week with the likes of the banks. You got to hear JP Morgan and Citi and Bank of America and Goldman. Oh my! A little later in the week, you've even got Netflix to kick that off. Oh, what we're going to do here momentarily is I'm going to give you a very detailed look at earnings. Not so much about like, hey, are they going to hit their numbers? Who cares? Okay, we're going to look and see, are they going to hit their expected moves? And more importantly, is implied volatility, is the market saying that risk is bigger this earnings period than any other recent earnings period? Think about that for a second, because earnings right now, I mean, we're in market limbo, right? Okay, we've got the Fed kind of backstopping this, but if earnings come out and they're not great, not even the Fed is necessarily going to be able to save us. I want to see in depth Is implied volatility of this marketplace, is it a tell? Is it saying anything about future risks? With that, let's get to it. Let's take a look at a couple of the charts, a little of these earnings previews. All right, to the charts we go. Let's kick it off with this discussion in Fed We Trust. One of the things that I want to point out initially is the rally back in the S&P futures versus maybe what's going on inside of some of the debt markets themselves. Effectively, what I'm saying is, let's take a look here again in the S&P futures or the SPX, whatever does it for you. But we've got a rally that moved from 2350 all the way to, let's just call it what it is, 2600, pretty much on the button right now. So we have this fairly shocking rally back to the upside, which is, hey, kind of that quintessential rip your face off rally. But at the exact same time, what are the debt markets actually effectively saying? And I think this is incredibly important to kind of be able to discern. And that is, okay, one of the moves inside of the bond product, all right, was wild. I mean, really kicked off again, and I'll get very, very specific here with dates. If you are into this, okay, check it against the S&Ps. The data actually kicked off again kind of mid-November when that wild rally kind of ensued inside of the ZB. And one of the things you have to recognize is this rally inside of the bond product itself, well, it was effectively caused by duck and cover, people. That was the marketplace running to the bonds because of the safety, effectively, of the bonds. One of the things that really stands out to me, and I'm bothered by, okay, yes, the bonds have actually tracked back. To some degree, they've tracked back. Yeah, not nearly as much, though, as the broader S&P 500. Okay, effectively what I'm saying is, yes, the S&P 500 has rallied. It's been huge, but the bonds, they're still in a highly guarded stance. So I took the time to also take a look at the notes. The notes are the exact same thing, where effectively, yeah, they've come back down. And again, what I'm saying to you is that have traders, have asset managers, have they really taken off their hedge? That is, have they taken off the fact that they dumped a ton of money into the bond market and then they've really not bailed out of the bond market, even though at the exact same time, okay, this wicked rally has kind of played out. So it's a little bit of kind of a warning shot, if you will, across the bow, I think, about this rally. Now, at the exact same time that I'm saying this, okay, check out the Fed backstop in terms of high yield junk. Okay, high yield junk. Well, okay, this is in stark contrast. Again, this kind of wicked selling really kicked off, and at this point in time, people, we were in trouble, just in trouble inside of the marketplace, and that is one of the most vertical moves I've ever seen inside of any chart. By the way, speaking of a vertical move I've ever seen inside of a chart, I've actually stepped in with a duration short now inside of HYG. Of course, we emailed that out, we texted out to all of our TheoTrade clientele, but we have now placed duration short inside of HYG. And that effectively means, well, that trade says it's indicative that this thing is supposed to turn around and sell back off to some degree. But its duration, it means in excess of about 3 months. Again, the credit markets are in one aspect here in HYG saying that we believe you, Fed. In another aspect, looking at the bond market, okay, they're not, okay, buying into some of the rhetoric of the Fed. And there's one other aspect I want to add to this, and I'm just going to bring it up. And this happens to be from Morgan Stanley. I like to give credit where credit is due. This is the Fed impact, and it's a little out there to kind of follow this, but bear with me here as I kind of take you through it a little bit. Effectively, what it says, okay, Morgan Stanley sees Fed's balance sheet, okay, reductions hurting the S&P 500 by 3.3% in 2019. One of the things I've been screaming about kind of incessantly is the Fed balance sheet. Okay, everybody is worried about the Fed fund futures. They're worried about the percentage. They're worried about, is the Fed going to bump a quarter point? Are they going to bump a quarter point? It doesn't really matter, because they're going to be contracting that balance sheet. And they've already started to contract the balance sheet. The moment they started to contract the balance sheet, okay, this happens to be the balance sheet that I'm drawing over here. And right there is the S&P 500. So if you wanted to put it into like quantitative terms, they're saying about 3.3%. But if you're aware, the marketplace has a tendency to overreact to everything. But I thought this was kind of interesting because, again, the entire marketplace, you look at the S&Ps, and if you've looked at the S&Ps over, pretty much since inception, I'll just pull up 20 years. In an average year, they're supposed to yield about 8%. Okay. Now, people always argue that it's 8%. Does that include dividend? Does it not include dividend? There's about 50 different statistical calculations you can use, but it's been about 8%. And as we just said a moment ago, now what the Morgan Stanley is saying, 3.3% of that is cut off. Okay. By the way, that's 8%. Including, some of the inflationary pressures. So you have 8%, take off 3.3%. Let's say take off another 1.5% for inflation. Inflation's running a little soft these days. What do you got? You got absolutely no reason right now to be long the S&P 500. I want you to think about that one because, again, in Fed we trust. All right, enough. Let's move forward past, all of the Fed rhetoric, which, again, the Fed, my opinion, they're there to try to create, kind of that short-term confusion when they are absolutely trying to contract the balance sheet and normalize policy without necessarily killing the marketplace. All right. The next point that I wanted to make is everything about the SPX. Why are we going to look at the SPX? Well, in terms of the SPX, I talk again excessively about the expected move because the expected move, there's so many different trades you can do on expected move. So this is where we started the week. We're looking for a $60 move. You know what we got? A $60 move. I mean, literally, if you looked at this on a 1-minute chart, in fact, we're on charts right now. I could probably do that. But if you looked at this on a 1-minute chart, you can see I highlighted this because we did come slightly outside of it. This is a 1-minute chart. That line that kind of bisects the screen right there, that is the expected move for the week. I mean, it is uncanny, just absolutely uncanny how close to the expected move we've effectively been. For those of you, if you've tuned into the class, like placing butterflies in and around the edge of the expected move, it's been a home run in and out again and again. These expected move butterflies, specifically for the Friday expiration, has been absolutely a home run. Now, more importantly, what are we looking like next week? Okay, so now that we hit one of those expected moves, well, this is next week. And we have a full trading week next week, and then we go into a 3-day weekend. But what are we looking like next week? So if I tune into the SPX, so much, can be learned by looking at the SPX. And I open up, this is the 7-day weeklies. This is exactly 1 week from now. There's about a $46 expected move. Now, to me, that's a little disconcerting. Why? Well, earnings are coming. There's a lot of, again, there's still more Fed speak coming. We still have a government shutdown. It's kind of funny because nothing seems to matter right now but what the Fed is saying. Again, we have earnings coming out. So this week we have this $40K, $6 move. The previous week, by the way, that's $46. So we're clear, higher or lower. And this week we effectively had a $60 expected move. So the volatility, again, has contracted. Now, why am I bothered by that? As I was mentioning a moment ago, and I'm going to cruise back out to the SPX, I'm going to give you a bit of a broader look. And again, I want to take off all the expected moves. Just take them off for a second. We're going to go to study. We're going to add study, volatility studies. We're going to cruise right up to historical volatility. And again, I've been talking a lot about this, some of these evening videos. This is averaged over 20 days, but we've been running right around 30%. So we've been running at 30%, yet the VIX, the VIX, just over this last couple of trading sessions is probably averaged even a little bit north of about that 20%. So where does that leave us? Well, effectively what it says, the S&P, the market itself is moving more. It's moving more than the options are paying us. Yeah, that's a no bueno. That's no bueno. Not if you're selling options premium. So what am I telling you right now? Iron condors, they're off the table. Don't do them. You just don't do them. I know we're trying to build inventory right now, but until, something has to give in this marketplace. Historical volatility either needs to come down and come down hard, or implied volatility needs to take back off to the upside. Now, I lean to the latter of those two in that, the marketplace is, it's moving and moving big. I think implied volatility has been crushed down because people have been so volatility starved. They run in there, like they're on fire just to sell some volatility. And unfortunately, I think people that sell volatility right here, if they sell volatility right here, they are going to get run over. Just going to get run over. Now, there's a huge amount, to go along with this. It's not just about, historic versus implied and so forth. And again, this historic volatility is just insanely high versus what you're getting paid for. Now, if I turn back on, okay, once again, some of these expected moves, I'm also going to remind you that earlier this week on Wednesday, when we did the video, we talked about being on the edge or inside of that expected move. And that's always a reminder because there's so many, again, different trades that you could build around the edge of the expected move. This week, again, I'll reiterate, I'm not selling options in the S&Ps this week. No way, no how. Not even close. $46 expected move. Come on, with a 30%, we're running at about a 30% historical volatility, okay? Ain't going to happen for me. The other aspect I think that begs to be looked at happens to be in the VIX itself. Now, for those of you that I'm going to geek out on you for a second, okay? So just bear with me here. So when I say geek out, historical volatility is actual movement of the VIX. Do you know that the actual movement of the VIX right now, okay, is about, it's basically 148%. It's not 1.4, but that's how it denotes it here. It's 148%. That's the realized volatility inside of the VIX itself. It's about 148%. You're like, oh, that's spectacular. What does that mean? Okay. Well, if you take a look at what's called the VVIX is 83. You're like, what? Okay. The options in the VIX are trading 30 days out. They're trading for like an 82, 83 vol. But the actual movement in the VIX is at about 148 vol. What does that tell you? You should be a net buyer of options in the VIX. You want to be a buyer of options in the VIX, not even so much in the SPX. Okay, you want to buy them in the VIX. I mean, people are like, oh, what am I going to do? You could even buy a straddle in here. That's how wild this kind of discrepancy is. You don't see stuff like this all that often. But implied volatility, I can say, okay, looks incredibly low versus the actual movement inside, again, those VIX options. Now, last but definitely not least, earnings are coming up. And again, there's so much about earnings. You're going to hear all kinds of stuff. I mean, you pull up like Goldman Sachs, you're like, are they going to hit their numbers? And I said a moment ago, like, I don't really care. No one cares. Oh, they made 628. Okay, who's the CEO? Is he running the treasury right now, or did he work for Goldman Sachs? I'm just kidding. We all know that everybody at the Fed and the Treasury ran Goldman Sachs for a period of time and probably still do. Nevertheless, by the way, everybody's conspiracy theory about Goldman Sachs, here's my conspiracy theory. Yeah, they're still not doing very good. That's pretty much since the financial crisis. What do they got? They got nothing. Absolutely nothing. But there is one important point to be made with this, okay? And I'm actually going to close this up. I want to know, okay, what's earnings looking like this time around versus some of the previous earnings that we've had. And you're like, well, I don't really get what you're saying. Look, we open up the 7-day options. Why? Because earnings are going to happen. When are they going to happen? This week. Take a look. We're going to zoom in real quick. When are they happening? They're going to happen on the 16th. Whether you like it or not, they're coming. Earnings are going to happen on Wednesday. Okay? That's the little earnings insignia here. Now, the marketplace, the implied volatility, is going to see that the earnings are coming. How do I know that? Okay, because I can see it. Look at the implied volatilities. See that? It's 41%, then it drops off. Okay, effectively what it's saying is risk now, not so much risk later. All right, but the point of this exercise is there more risk right now in Goldman Sachs versus maybe the previous earnings announcement? Well, first and foremost, we got to go back. We got to look at the previous earnings announcement. Okay, so I'm going to zoom out. By the way, I can look for this announcement and this announcement and this. I'll look at the most recent earnings announcement. And that most recent earnings announcement happened on October 16th. And it's like a little blip on the chart. It didn't do anything. Even volume wasn't that elevated. But why am I using Goldman Sachs? I don't know. Interest rates have been flying around a lot lately. Like, I want to know, okay, are the interest rates and the shift of interest rates and all of the Fed rhetoric and the fact that the market tanked, okay, are the banks going to make money? Or if they're on the wrong side of the rates, they're going to get absolutely slaughtered out there. Like, what's going to happen? Because the banks, these things move markets, okay? The XLF, it moves markets out there. So why am I doing this? Well, here, let's get into it. Let's go right back to the 16th. So I go over to the Analyze tab and I go into Think Back. What's Think Back? It's, well, the ability to go back in time. So as I said, again, I go to the chart. I look specifically at the date. That's October 16th. And I look forward over here and it's coming on January 16th. Okay, before, after. The market at this point in time, so everybody does remember, the market was already tanking, okay, quite a bit in October. So you would think that the volatility would be rather elevated in October. Now, we're looking at the implied volatility and the expected move, okay? It was a $221 product, okay? But to make this fair, here we are looking at it on a Friday. I'm actually going to back the date up, okay, to the weekend before the week of the earnings. Why? Because it effectively gives me a cleaner take on the implied volatility looking at it a few days before. And the volatility was basically 38% with about a, $9 expected move. So it's about a 38 vol, $9 expected move. What are we at right now? Okay, what are we at right now? We have a 41 volatility. What are they actually saying right now? We're going to come into this earnings period. There's more risk. That's what it's saying right now. Now, I know you guys look at the expected move. Oh, but the expected move is only $8.40. Yeah, but it's a $176 stock, whereas before it was a $213 stock. Okay, the bottom line with this, okay, the risk is elevated now. And why I find that interesting is the risk is elevated more now. We just went through this, wild sell-off, okay, recently, but the risk of the marketplace is abated right now. Whereas Goldman Sachs at this point in time, I mean, this was October 14th. This is right in the middle of a big sell-off, only 38 vol, okay, 38 vol on it. So we are looking right now like there's going to be more risk surrounding the Goldman Sachs earnings announcement. And I think that's of critical importance. The next one to bat, I want to take a quick glance at JP Morgan. You guys can kind of go back and do this a bit yourself, but in JP Morgan, we take a look at JP Morgan. Its earnings are coming out again on the 15th. It's even before Goldman Sachs. Oh, how exciting. Not really, okay? Its previous earnings announcement, though, was on the 12th. So what do? We go back in time. We'll just go over here to the 12th. We just go right to the day. Let's not necessarily cut to the chase and just get right to it. What we were looking at that particular day, and when I say the 12th, okay, a lot of this is, again, the 12th being October 12th. So a lot of the earnings announcements when the banks, they come out like Friday morning. This is a little bit of a different cycle. Anyway, in here is about a 30% IV. In effect, what do we have here? Almost 32%. We're gauging considerably more risk in both JP Morgan right now and Goldman Sachs. And again, I'll reiterate once again that if we kind of zoom out for a second, you can see these stocks are getting hit fairly hard at this point in time. And the overall marketplace, if you look at the spiders, okay, when those stocks were releasing earnings, we were coming down. The VIX was getting heated up, and yet the volatility right now for the financials is even higher. Okay, last but not least, and I'm not going to torture you too much over here, happens to be none other than Netflix. Now, Netflix, I was looking at this one a little bit earlier, kind of surprised me. So it's on the 16th. So again, we cruise over here to the trade tab. What do we look at? There's an 83 vol and a $32 expected move. $32 expected move. Now, if we actually cruise to this, right to the earnings date, which happens to again be effectively the 16th, what do we have? Okay, it's about a 131 vol with a $35 expected move and a $340 product. Okay, right now it's basically a $340 product. What kind of volatility are we looking at? 83%, $32 move. So to compare and contrast, the volatility in Netflix, ironically, is slightly lower. I mean, this is one that's a shocker. Let me just tell you, right now in the banks are showing more risk. Tech, okay, our first one, at least Netflix, is actually showing slightly less risk. Well, let's just say this. In Netflix, I wouldn't sell any option premium naked in here. Not when they're actually paying you less this time around. Now, granted, the stock did move, okay, $100 recently. It's a tremendous amount to think about. But I think the overwhelming theme and the takeaway from looking at some of those implied volatilities here on this weekend update, it's about the financials. The financials have an elevated volatility stance coming into their earnings. And clearly the Fed has everything to effectively do with this. And the reason I'm going to leave you with this last thought, okay, the XLF. Why are we looking at the XLF? Why am I leaving you with this thought? Because it's the XLF that got us into this mess in the first place. One of the things I told you all the way back in October, for those of you that have tuned in, okay, this, people, is what we call kind of the Maginot line of the marketplace. The financials have dictated what the S&Ps have been doing for a considerable period of time. And that line is 2650. Now, given the fact that there's, again, an increased volatility this week and almost as much as $1 expected move in here, so we can expect to move to 2550 all the way back down, okay, to the like the 2350 kind of marker over here, there's some fairly dramatic amounts of risk. Anything in this marketplace, okay, specifically the XLF, anything below 2650, we still consider the S&Ps in serious trouble. Okay, this is a lead weight on the back of the S&Ps, and even though the financials rallied out of the hole to a degree, if you look at the XLF and compare it to the rally in the S&Ps, it's meager. And the fact that the financials have got earnings this week, okay, this could actually roll the market back over. However, on the contrary, a couple of those earnings come out, right? We hit 2650, S&Ps can take back off. We are at a crossroads. Most important at this crossroads is you have to recognize there are signs, like in the bonds, that risk is still in play. There are signs in the volatility futures that risk is still in play. Okay, I can't stress that enough. If there's a bias I have, it's leaning to the downside. Right? I'm leaning to the downside. The market rolls back over and sees some sell side activity. I can't tell you specifically if that's going to be predicated here in the financials. Nevertheless, this is an absolutely pivotal week. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.